Now let's practice the operating lease related to lease bonus. Lease bonus is totally opposite situation from the discounted rent we previously exercised. The discounted rent is for the buyer's market, less payment for the first year because with low demand, but the lease bonus is totally seller's market with high demand in the market. So the lessee should pay a more payment for the first year to give the bonus to the lessor. Okay, the prepayment for future expenses should be classified as an asset, deferred charge, and amortized using the straight line method over the life of the lease. That is the point of the lease bonus. So we are going to touch with some the deferred concept, unearned revenue, and a prepaid rent that we previously exercised maybe week 1 or week 2. So let's go to the practice. Lease bonus, the $5,000 paid in advance. January 1st, even though they haven't used this facility yet, or the lessor hasn't delivered the service yet, but they already paid $5,000. That is deferred concept. And annual lease payment $9,000 for $5,000 at year ended. So always the same procedure. Step 1, calculate total minimum lease payments with the lease term, and we calculate the rent expense, the minimum lease payment divided by the lease term, which is the actual use of life. And then prepayment recognition for future expenses classified an asset, prepaid rent expense, that is the asset account, the deferred asset account, or as a liability for the lessor, I should recognize another revenue, which is the deferred liability. And amortize the prepaid or another revenue or the expense using the straight line method over the life of the lease. Okay, so let's calculate the minimum lease payment first. $5,000 was the in advance payment plus how much is the annual lease payment? Right, $9,000 for 5 years. So $50,000 is the total minimum lease payments. Now, how long years? Right, 5 years divided by 5 of this. The minimum lease payment is annual rent expense or revenue. I'm gonna write down annual rent expense or revenue for the lessor. So let's record. Let's see operating lease. Now the January 1st at the beginning. So the lessee paid cash first, $9,000, and then what account do you need? Right, this is deferred asset account. They paid in advance, but they haven't received the service yet. They have a right to receive the service, right? So we record prepaid rent expense, $5,000. Okay, $5,000. Then once they use this asset, then they record rent. They should record the rent expense. How much is the rent expense? We already calculated here. Always equally distributed, because when we measure expense, we used for the period. So we have equally distributed this total minimum lease payment along with the rent term. So $10,000 is actually they have used, right, for this facility. And how much the company paid for the second year. From the second year, how much was that? $9,000. So $9,000. And then because they use this asset, but they paid only $9,000, then the difference between two should be also kind of the cost of this, cost of using this asset. So the cash $9,000, you should definitely $1,000. But what account do we need? Right, because we use this asset until the use of this asset, 5,000 prepaid rent expense should be amortized by 1,000, because this $5,000 is the paid in advance along with the life of this the rent term. So 5,000, right, out of 1,000. So we record 1,000 prepaid rent expense should be reduced by 1,000 here. And then let's report post this this journal entry into the balance sheet. So cash minus 5,000 and minus 9,000. And then the prepaid rent expense here or here, right? Prepaid rent expense, we recorded $5,000 for the asset, and then we reduced $1,000 once we used. The rent expense to equally distribute $10,000 should be retained into the retained earning. So we're done. Next, lesser operating lease. January 1st, okay, the same. We just can mirror, reflect the transactions and the balance or income statement account from the lessee when you create the lesser operating lease. That's why we want to compare between two. Here, the lessor now received cash, $5,000, but they haven't delivered the service yet. They just received cash first. That's why they owe to deliver service. So unearned rent revenue should be recorded in the same amount of this, right? So $5,000. Now, second year, this is not second year, sorry, first year end rent fee received and amortized. So one more time, here the company received cash. This is 9,000. Okay. So again, this $5,000 is not the rent fee at this moment, but it will be distributed along the life of this lease term. But not 5,000 that's in total, but distributed by the term, so $1,000 each year. So cash and then rent revenue. How much is the company can recognize? Now the rent revenue, $10,000 because they delivered the service. Now they earned the service. Revenue. So $10,000 recorded on the credit, and then finally they should reduce this liability. This again, the unearned revenue, rent revenue is liability because they owe to deliver the service, $5,000. Once they deliver the service, but they recognize the 10,000, where is the rest of 10,000? 1,000. So the difference is $1,000 they deliver the service. Then totally $10,000 is now the cash received and the company can recognize. Okay. Then let's record the cash in 14,000, and then another revenue, the rent revenue starting from $5,000 obligation should be reduced by $1,000 once the company delivers the service, and then the rental revenue, $10,000 should be recorded in the first year because they delivered the service by $10,000 out of $50,000 total payment. And then the retained earning should be retained in the should be recorded from this income statement account and rental revenue. Okay, so that's all. See you in the next video clip. Bye bye.